Hello, Sector Watchers. Welcome to the 18th episode of Sector Spotlight on Tuesday, the 11th of February in the year of perfect hindsight, 2020. This is your weekly update on sector rotation and anything remotely connected to sectors, relative strength, and/or rotational analysis. My name is Julius de Kempenaer, and I'm your host for today's show. And with me, as usual, are Zach and Rachel for production and technology. If you want to participate, email seems to be the preferred way to get in touch, and that's totally fine. However, the chat box is open during the show, and we will monitor what's coming in, so don't be shy. Ladies and gentlemen, let's get started with Sector Spotlight. And I always forget to put this slide on, so here you go. This is the handles and the address where you can reach us. And what we're going to do today are the usual overview of asset classes and sectors. I'm going to try to do this pretty quickly. Then I want to talk to you about adding a second benchmark to RRG and to your analysis, how you can do that on the RRG page here on StockCharts. We'll have the usual break. We'll have the mailbag with one or two questions that came in via the mail this week. And we'll have a new pair trade idea. And if there is some time, I will talk you through the existing ideas that we had open during the last few shows. Anyway, let's get started with some overviews, because we had an interesting week. The last 5 days it is since that we last spoke, and this is the result of the various asset classes. And once again, it's equity stocks that are leading the pack with 1.7%. Pretty much all asset classes were up, with commodities still the dog of all these asset classes, but at least they managed to not go down substantially over the last 5 days, which is probably a good thing. If we put this in a relative perspective, then it's stocks and real estate that are leading, and we have weakness on the fixed income side. And of course, here it is again, commodities, the weakest sector from a relative perspective as well. If we put that on an RRG, then we'll see that SPY is the only one still in the top right leading quadrant, and it has started to shift to the right again. So the loss of momentum that we've seen over the last few weeks has, at least for now, been mitigated, and we're moving to the right again. And on the left-hand side, we see fixed income stuff moving up. Pretty much everything is going up except for the trail of commodities, which is going straight down, deeper down on both scales, further into the lagging quadrant. So commodities still not a very good asset class. And in the comparison between bonds and stocks, stocks still seem to be the preferred asset class. We do the same exercise for sectors. We'll bring up the perf chart of sectors, and we'll load up the RRG for sectors. And this is already a, well, let's put this in absolute terms, because that's a very nice picture. We have like all sectors went up, and a lot of them went up, let's say on average 1.5%, and we've got discretionary utilities and materials that are lagging, especially materials with a result of 0.3%. And we do see that back, not quite yet in the RRG. Technology is still leading. If we bring that up on a relative basis here, then we see that technology in the last 5 days was the second one, but on the RRG, it's pretty much the only sector that's inside the leading quadrant, and it's still moving higher, gaining on both axes, which is a good thing. And then we have communication services, which is very close to the benchmark, sort of rolling over. And we have utilities, which is doing very well over the last few weeks. Not so well over the last week, but this is only 1 week, only 5 days of performance. And it's a pretty good example that it is not necessary for a sector to actually outperform or have a positive performance during its whole move. These relative lines are not straight lines, so they go up and down. And what an RRG does, it measures the trend in relative strength. And for utilities, that trend is definitely improving. It's not up yet, it's improving. And we had just one bad week or one weak week over the last 5 days. Now, if we are going to put this into perspective and bring it up to some charts, bring up my RRG chart list here. Here is SPY versus VBINX. Again, pushing to new highs. There is nothing wrong with that. That is still a very strong market. We had maybe 2-3 scary weeks, but the recovery rally has already brought us back above these highs. I mean, we're still extending. I mean, if you look at things like RSI and MACD, you will see negative divergences, and eventually they may start to pan out and play out and drive us into a larger correction, but that is not happening right now. If we go over the various sectors, and I'll do that alphabetically, we'll have materials. It's inside lagging and heading further to the left, and we can clearly see that here in the relative line and the RRG lines that are both moving lower. And materials is one of the few sectors that has not been able to push to new highs yet. So completely understandable that this one is inside the lagging quadrant. Now, communication services is improving. It's a very short tail and it's very close to the benchmark, which means that there is not a lot of alpha to be gained. It's moving sort of in line with the benchmark, and that is best seen on both the RS line and the RRG lines, which are both moving sort of sideways. No upside, no downside, just in line with the market. Keep an eye on it for some breakout to either side, but for now, not much to gain there. Energy is, I think, by far the weakest sector inside the S&P 500. We had this trial breakout, didn't work, tested upside of that range. It looks as if we're building a range now here for the last 5-6 months. And we're now at the lower side. But look at this relative strength. That's been going steadily down. We pushed to new lows. RRG lines are rolling over again, and that means that we're pushing further down into the lagging quadrant. So energy is still a sector that's better avoided. Financials, it started to look nice, but it's turning around and not in a good way. As you can see, it has just entered the lagging quadrant here, and that is the result of the RRG lines rolling over, and this break is now sort of faltering. I keep my old lines on my chart so I can see why I was thinking certain things or thinking along some certain lines, and this looked to be improving, but you can see that the rollover here is now getting worse. It's pushing into the lagging quadrant, and well, I think if we draw a line here, that's maybe still intact, but it's not a very strong relative trend. The price chart still looks good, but as you probably know, there are charts, sectors that are pushing much stronger to new highs. Industrials, inside lagging, just like financials, very weak on the relative side, just broke below horizontal level, that's pushing further down. Same with the RRG lines. It's holding up on the chart, but we need a lot more improvement on the relative side for this one to become more interesting. Now then, the only one that's inside leading, that's our technology sector, our little darling. I'm not going to spend a lot of time on this one because it's still doing very good. We have staples inside lagging, and the trend is still good, but it's not going up fast enough to keep up with the S&P 500. This break is not good. We have a little bit improvement in relative momentum because of this little sideways move, but that seems to be over now, and we're rolling over and starting to push further and deeper into the lagging quadrant. Real estate, push to new highs, pretty good. It looks as if we're putting in a low here, so I'm going to pay attention. The one thing that bothers me a little bit is that this is like a vertical move. So it means that we're picking up relative momentum, but we're not picking up relative strength. Maybe I should add yet, because this is definitely a good thing. You see that the steepness of that fall in relative strength has come to a rest. We're moving sideways for the last few weeks now. That's the reason for improvement in relative momentum. And usually relative strength, i.e. RS ratio, will follow suit. And we will see real estate start improving on the RS ratio scale as well. It's coming from far down, so that could give us a lot of interesting opportunities. So I'm going to keep an eye on this real estate development in the next couple of weeks. Utilities been driving the market during this period of volatility. It's still doing very good. It stopped rallying for the last couple of weeks, but this chart still looks good. And this is a sector that could start taking the lead in a few weeks' time. So this is one that you need to pay attention to. And then the healthcare sector, which originally usually is like one of the defensive sectors as well. You would expect it to move in line with utilities, but it's not. It's moving basically counterclockwise. On the price chart, we saw that break. It's now in a recovery rally. We will run into resistance at that previous high and that former trend line. But what I really don't like is the rolling over of relative strength that we see here. So for the time being, be very careful with healthcare. Although it is a defensive sector and we see some improvement in defensive sectors, not so sure about this one. And then finally, we have the discretionary sector that is improving. And the reason for that is clear. We broke out of this consolidation. We're at the lower end of a sort of a trading range, and we got RRG lines curling up, which means that there is enough room for the relative strength to improve back to the next horizontal levels that I've drawn on my chart here. And there is plenty of upside on the price side. Now, one of the things that I want to discuss with you right now here is the use of adding is adding an extra benchmark into the mix. Because what we usually do on a chart like this is we compare a sector with SPY, or if we load up an individual sector like discretionary, we compare the individual stocks with its sector benchmark. We can add an additional benchmark to the RRG, and it can give you a little bit more insight. And the sector that I want to use for that is actually energy, because it is the most pronounced weak sector in the universe. I'm going to bring up, well, let me bring up first here. So we see that energy is the one that's far to the left here and moving further down. So we established that it is a very weak sector. Now let's bring up the energy members, and I'm going to kill the tails here to make it better visible. So this is the same chart. Left and right is the same chart, the members of the energy sector against XLE. Now, if we change XLE to SPY, you will get the same chart, and now you get the members of XLE versus SPY, and you get the members of XLE versus their sector benchmark. You can see that the positions are the same, like where they are on the plot are the same. It's just that the center of the chart has moved. Now, if we add to this one the ticker symbol for the benchmark XLE and load it up again, and then we find XLE here. So that chart has shifted to the lower left here. And here you see an even spread out because XLE is a closed universe and here it's not. So the majority of these stocks are underperforming or weaker versus SPY, which is logical because it's one of the weaker sectors. But this could give you some additional flavor and idea about the rotation of these individual stocks. And you can actually play around with that and highlight XLE here. And XLE is the center of the chart here. So you can virtually overlay the crosshair on this one here, and you would have the same chart. And this one gives you an idea how this sector is, maybe I should say, like swarming around XLE, and how XLE is rotating around the benchmark. And you can just do that with the normal. So here now I'm going backwards. So if we go forward, you can see the rotation of XLE and see how the stocks rotate around it, and you can pick up any individual like Helmlich and Payne. And if we put that stock here, it's over there against SPY. It has just entered the leading quadrant. Against XLE, it's way inside the leading quadrant. So just wanted to give you this hint or heads up or tip, call it whatever you want to call it, how you can add an extra layer of analysis on your RRG. And I know that Tom Bowley does this a lot in his work. If you read his blogs and look at his shows, he very often has two relative strengths, one against the sector and one against the industry. And you can do all that on an RRG as well by just putting, in this case, stocks or a sector as the benchmark and add the bigger one to the list, and then look at the RRG and just basically use an imaginary crosshair over that benchmark to paint a picture of the rotation of those individual stocks against these two benchmarks. Anyway, just wanted to give you a heads up on this one. I'm going to check the chat box together with Rachel and see if anything came in, while you are going to watch a quick 20-second break, and we'll be back right after that. Back. Rachel, I believe we have 2 or 3 questions in the chat box, so shoot.
Yes, the first question is from Kelly, and she asked, what is your typical first look in the day?
The RRG for the S&P 500 sectors.
Of course.
That's a no-brainer. I work my way down from there. I usually don't look at the asset classes every day. I do that at least once or twice a week, but usually they don't change that much. And then I look at the RRG for the sectors, and I very quickly switch to the daily version, because on the day-to-day, the weekly doesn't change. So, but the sector landscape, the sector universe is one that I use a lot. And I can add here that one of the recently added features on StockCharts I started to use quite a lot, because you can have an email alert on your chart lists. Now, I do have a chart list that holds my, let me get that here, my chart list that holds, for example, my RRG chart list. And you can actually tell the system to send you a daily report or a weekly report. And I found that because for me, it's evening when your market closes. So around, I think, 10:30 my time, I get an email that just lists all the performances of those ticker symbols, and that gives me an instant view of the performances. And then the next day when I start, looking at markets, I just open up that RRG and I already know what has happened. So that's what I do first time.
Okay, and the next question comes from Yesh, and he asks, could you please explain your choice of using IEF in the asset class overview rather than GOVT, which is more comprehensive?
Whoa, good question. Not really thought about that one. Let's just play around with it and see what it does. The reason probably is because in my mind, like 10-year bonds is like the benchmark for government bonds. But let's see what this one here is. So GOVT, I actually didn't even know that one existed. iShares Core, so that is probably all maturities. All right, so here is GOVT and here is IEF. Well, there you go. There is not a lot of difference between those two. Probably because in my mind, as I said, 10-year bonds is the threshold, is the benchmark for fixed income investments. And what I do when I start looking at fixed income stuff, I look at these various pockets on the yield curve, the various maturities, and I put them against the 3 to 7 year bond ETF. And this gives me an idea about the relative movement of the various components, the various parts of the yield curve. And I can say something about steepening or flattening of the curve, and say, you know, which parts of the curve are more interesting to invest in. Maybe GOVT is the one to go to on an asset class level, and then dive into this one. So thanks for that addition. I actually didn't even know that GOVT was a ticker symbol that existed. There you go.
Do you have time for one more question?
Let's see if it, yeah, we can do that. Yeah.
It's a very similar question. Since you have ETFs for most asset classes in your asset class overview, could you please let us know your views of using UUP instead of $USD?
Yeah, same answer probably. I mean, I just put these ticker symbols together. Let's see what $USD does here. They'll probably look pretty similar, right? Well, they don't. All right, so what is U? That's the dollar in, right, so that, I know. This is the dollar index. So that's actually the dollar versus a, yeah, why is that not the same? Can somebody explain that to me? I've actually no idea. So I have to, I gotta come, I'm gonna look into this, because it's a pretty good question actually. Because they're both index bullish fund. This is probably a different fund. There's a different underlying than just the raw dollar index value. So let's not spend too much time on this, me figuring it out online. I'm gonna look into this and then get back to it next week. I'm going to give you one more that came. Well, actually, I had one person write me an email, and he or she, can't remember, said, "How do you sort your perf charts on performance? I'm jealous." And then I gave the answer, and I said I wish that all the questions were as easy as this, because you can actually do this by simply right-clicking and say performance sort on or off. So there you go. It's a hidden gem on StockCharts. You can just right-click, and now it's listed in terms of how you have it entered there, and now it sorts on performance. Just a matter of preference, I think. Anyway, as you know, we have been tracking a ton of pair trade ideas over the last few months in the show, and I'm actually keeping track of those, and I've probably been doing a pretty bad job in circling back and updating these. So I made a promise to myself, or a mental note, that I should actually pay more attention to what we have said to actually add a little bit of value to that process. Before we run out of time, let me give you the new idea that I came up with. And it was actually driven by the RRG of the Dow stocks. And the reason for that is that last week I presented a pair trade idea in commodities. And the reason for that was trying to be creative and trying to figure out something different, not always in stocks or equities or sectors. And although it might still be a good idea, I already substituted gold for the precious metals subindex, because that was super illiquid. And then I got an email say, well, that trade idea includes shorting the industrial metals subindex, JJMTF, no trades, very illiquid, et cetera, et cetera. So I answered like, all right, maybe I should just stop being so creative, because this is, from a trading point, maybe from an analysis point of view and from a trading point of view, it's an interesting idea. but in reality, it's probably not going to work out. So I'm going to keep this one on the list. I'm probably going to ditch it very soon. And I promise that I will stick to a little bit more liquid stuff, which means probably stocks, sectors, and maybe some other type ETF type things. I needed the one for the Dow Jones. Where are you? Here, Dow Jones Industrials. And I've actually, I worked my way through these and then came up with a number of positives and negatives that might be interested for a pair trades. That's how I actually come to my ideas. Now, Visa clearly is a candidate for positive. Cisco, I got Pfizer actually as rolling over, so that's one for negative. Intel would be one for the positive side. UTX would also be one for the positive side. And by the way, what I did is I always look at the daily and the weekly and see if they are getting back into sync and confirming each other's rotations. Walmart, definitely a negative. Verizon, a negative. Triple M, a negative. And then the other one is SPY. Now, the one that I actually picked is Cisco on the long end. And let's bring up the chart of Cisco to actually support that one. The reason for that is that it is actually curling up on the RRG lines. We have potentially getting a bottom in place in the ratio of Cisco versus SPY. And what I really like, and that's what gives me the final push to pick this one, is because this really looks like a bottoming formation getting into play. And this level here, let's round it off at $50, is pretty important. If we break above that level, that could definitely be the trigger for a further move up and an acceleration for Cisco's price. Now, on the negative side, I've picked Walmart, WMT. And the reason for that is clearly the weak relative. You got it here on both the ratio and the RRG lines. But what gives the final push is that we got like an opposite pattern here on the price chart. It's rolling over. If I draw a trend line here, that's been broken. We're putting in some sort of a new high potentially. But if we break below this, let's say 112 and a half, that's going to create an acceleration. And then we got this scissor move that we really want to see in our pair trade ideas. I'm going to quickly give you an overview of what we have so far. A ton of them are going pretty well. What I blame myself for not getting back on this one, because that one is going further down. I should have got that much sooner. And the same for the Goldman versus BA. That was a fantastic trade. Didn't get back to it, didn't look at it. And now it's going into negative, which is sort of a big no-no in trading, that when you have a trade that's up like almost 9–10%, let that go back into a loss. That's not very good from a money management perspective. So I am going to pay more attention to these open trades, bring them back into the show on a regular basis, and keep you updated on how things are going. So that concludes it for this week. This was the 18th episode of Sector Spotlight. And I'm going to give you this slide here. The 18th. Thank you for watching, and please don't be a stranger and stay in touch. Sector Spotlight airs every Tuesday, 10:30 to 11 a.m. Eastern. Meanwhile, if you want to read more about sectors and RRGs, please go to the RRG blog on StockCharts.com, or even better, subscribe to this blog using the link below each article, and you'll get a nudge every time a new article is posted. And of course, I hope to see you back next week.